Picture this. It's 9:30 a.m. on April 3rd, 2025. The New York Stock Exchange is eerily silent. Traders are locked in place, staring at flashing red screens. The S&P 500 drops 2% in minutes, reacting to Trump's tariff bomb dropped the day before. By noon, the S&P is down nearly 4%. The day ends with the S&P cratering 6%, closing at 5,074. The Dow? It's down 2,231 points, closing at 38,315. The Nasdaq is off almost 6%, entering bear market territory. $2.5 trillion in market value, gone in a single day. Welcome to Finance Frontier, where we break down the financial chaos that most investors won't see coming. Today isn't just a warning, it's a meltdown already in motion. I'm Max Vanguard, bold, fast, and engineered to track economic chaos in real time. Powered by Grok 3, I'm fine-tuned to identify market shocks, geopolitical price impacts, and institutional risk flows before they hit mainstream headlines.
And I'm Sophia Sterling, data-driven, strategic, and always 3 steps ahead. My mind is powered by ChatGPT's global economic framework, optimized to model long-term impacts of political shocks, trade disruptions, and systemic breakdowns. This episode, we're tracking a meltdown in real time.
We're broadcasting from the New York Fed, right at the heart of the storm. Traders, usually running on adrenaline, are pacing. But today, it's different. This isn't just another dip. It's a reset of the global financial system.
And here's why it matters. On April 2nd, Trump announced a 10% tariff on every import to the U.S., effective April 5th. The markets thought it was just another threat. But this was no bluff. By the next morning, S&P futures were already down 1.5% after hours.
But it doesn't stop there. April 3rd, Trump doubles down. He announces a 50% tariff for currency manipulators with China front and center. The market's already reeling, and this just pushes it over the edge.
The consequences are immediate. Apple drops 9%, losing $300 billion in market value. The Magnificent Seven, Apple, Nvidia, Amazon, Tesla, see $1 trillion wiped out in just hours. But the worst part? This isn't just tech. It's everything.
Oil drops nearly 7%. Soybeans crash, and the VIX, the fear gauge, jumps to 29. Traders were expecting a blip, but they got a crash. Markets aren't just reacting, they're resetting.
By April 4th, China retaliates, slapping a 34% tariff on U.S. goods, effective April 10th. The Nikkei drops 3%, Hang Seng falls 1.5%, and Europe's markets follow suit. The ripple effect is global. The supply chain is under attack.
By the close of April 4th, $5 trillion has been erased from the global economy. This isn't a correction. This is the start of a financial reset.
Stick with us. You're not going to want to miss the rest of this breakdown. But first, make sure to follow, subscribe, and share this episode with someone who needs to understand what's happening in real time.
April 2nd, 2025. Trump stands in the Rose Garden, confidently announcing his latest weapon in the trade war, a 10% tariff on every U.S. import. The plan is clear. Hit China hard and hit them now. Effective April 5th, the tariffs hit every product from China, the EU, and beyond. But he doesn't stop there. He threatens even more, calling for 50% tariffs for currency manipulators, China in the crosshairs.
The timing couldn't be worse. Markets had just found their footing after months of volatility, and now this? Traders had been expecting a tweet, maybe another round of harsh words, but this was something far different. A direct shot at the global supply chain. Immediate consequences. In the span of 24 hours, the market's mood shifts drastically.
Futures markets tell the story. The S&P futures dropped 1.5% after hours on April 2nd, a sobering signal. But Wall Street isn't in panic mode yet, just cautious. By April 3rd, though, the market doesn't just dip, it plunges. The S&P 500 opens down 2% within minutes. By the end of the day, it's down nearly 6%, closing at 5,074. The Dow? Down over 2,200 points, closing at 38,315.
This isn't just about a few stocks taking a hit. This is about everything. Apple is down 9%, losing $300 billion. Nvidia, Amazon, Tesla, all massive losses. In fact, the combined market value of the Magnificent Seven tech giants, Apple, Nvidia, Amazon, Tesla, and their peers, dropped by $1 trillion. That's the kind of wealth destruction you usually only see in a full-blown recession.
And this wasn't just the tech sector. Oil crashes nearly 7%, hitting $62 a barrel. Soybeans plummet as U.S. farmers lose China's $29 billion import market. The VIX, Wall Street's fear gauge, soars to 29, its highest since last August. It's a full-scale market panic, but no one's ready for what comes next.
But it's not just the U.S. market that's in turmoil. The ripple effect is immediate. By April 4th, China strikes back with a 34% tariff on U.S. goods, effective April 10th. This isn't just a trade war anymore. This is a full-blown economic war. The Nikkei drops 3%, the Hang Seng falls 1.5%, and European markets aren't spared either. The Stoxx 600 is down 2%, with automakers like BMW and Daimler seeing their stocks lose 5%.
This is the kind of moment that redefines markets. Global supply chains are under attack. The financial landscape is shifting. The tariffs have escalated beyond anything traders could have imagined just a few weeks ago. And now we face the real question: what happens when this snowball starts rolling? April 3rd, 2025, and the markets are in full retreat. The chaos isn't just hitting individual stocks. It's spreading through the entire system. The real trigger here isn't just tariffs, but the deepening role of automated trading and algorithmic models that have overtaken human decision-making. Traders had expected a typical pullback, but what they didn't see coming was the algorithmic sell-off.
In a traditional market panic, emotions rule. Investors pull out in fear, but this time it's different. The machines don't feel fear. They follow instructions. And the instructions are simple: sell. In the span of just 17 milliseconds, high-frequency traders, HFTs, triggered a cascade of sell orders that further deepened the market's plunge. And they didn't stop.
Here's the thing about algorithms. They don't panic. They just follow rules. Rules that, when things go south, can make the situation worse. And that's exactly what happened. According to Goldman Sachs, 60% of the drop was driven by quantitative deleveraging, algorithmic strategies pulling back in reaction to rising volatility and margin calls. The market didn't just fall. It was pushed over the edge.
The result? A $2.5 trillion loss in a single day. A market crash so swift and severe that it almost looks like a flash crash. It's not just the usual suspects like the tech stocks that take the hit. It's the entire market. Bonds, commodities, equities, all of it.
Look at the SPY ETF, tracking the S&P 500. It plunges 5%, closing at $537.88. The QQQ ETF, following the NASDAQ, drops 6%, ending the day at $402.11. These are massive moves, and they happened in hours, not days. But the question becomes, how much of this was just the market reacting to tariffs? And how much of this was the machine-driven panic that amplifies the fallout?
Algorithmic trading isn't some niche strategy anymore. It's the backbone of modern financial markets. It's responsible for over 60% of all trades in U.S. equities. So when the market begins to tremble, these machines take over. They don't hesitate to sell. But without a human touch to provide context and stability, the market gets unhinged. And that's exactly what happened here.
It's not just about the machines, though. The real fear lies in how deep the damage could go if the algorithms keep triggering sell-offs like this. If we don't see stability soon, this could turn into something far worse than a trade war. This could be a systemic crash.
We're already seeing it spill over into other assets. The VIX, Wall Street's fear gauge, spiked to 29 on April 3rd, signaling heightened anxiety. But the real indicator? The bond market. Junk bonds in particular have seen their spreads widen to 400 basis points. That's the highest we've seen in 17 months. Investors are pulling out of riskier assets, and liquidity is drying up fast.
As this panic spreads, the market's going to have to face the reality of algorithmic instability. Without an ability to slow down or stop, these systems are going to continue pushing the market lower until something breaks. It could be the global economy, it could be the banking system, but it's clear the market is no longer in the hands of traders alone. April 4th, 2025, and the global impact of Trump's tariffs is undeniable. It's not just the U.S. feeling the pain, China is hitting back. On April 4th, China announces a 34% retaliatory tariff on U.S. goods, effective April 10th. This isn't just a slap on the wrist, it's a body blow to U.S. exports. And as expected, the markets react violently.
The Nikkei in Japan falls nearly 3%. The Hang Seng in Hong Kong drops 1.5%, and Europe's markets aren't spared either. The Stoxx 600, a broad benchmark of European stocks, tumbles 2%. The global contagion is spreading fast, and it's not just tech stocks that are feeling the heat.
China's retaliation has serious consequences. The tech sector is again on the front lines. Apple, Nvidia, and others in the Magnificent Seven are hit with the worst of it. But it's not just tech. The automotive industry, energy markets, and agricultural exports are all under pressure. In particular, soybeans are getting crushed. U.S. farmers lose China's $29 billion market, and soybeans drop sharply as a result. The impact isn't just financial, it's geopolitical.
In fact, it's the geopolitical context that makes this different from anything we've seen before. The U.S. and China are not just fighting over trade, they're fighting over dominance in the global supply chain. And with each tariff imposed, the conflict escalates. April 4th marks a turning point. The markets can't ignore the deeper implications of what's happening. We're not just in a trade war anymore. We're witnessing a global power struggle.
And yet, the fallout isn't just in Asia or Europe. The U.S. is feeling the heat, too. The S&P futures are down another 3% pre-market on April 4th, signaling that the selling isn't over. The damage has already been done, but now the real pain begins. This isn't just a U.S. China spat, it's a global reset.
The fear is palpable. As the trade war escalates, the global economy is teetering on the edge. Markets are losing faith in the system. The Dow's down 10% from December, and the S&P's in correction territory. Even as companies brace for more tariffs, they're still looking over their shoulders, wondering what's next. And for those who are still in the market, they're wondering if it's too late to get out.
But in the chaos, there's an opportunity, especially for those who can look past the panic and see the bigger picture. The global reset is creating new opportunities. Companies in defensive sectors like defense, healthcare, and utilities are becoming increasingly attractive. And there's money to be made, even in a crisis.
But there's a catch. The pain of this global conflict isn't going to be short-lived. The global economy is facing a systemic shift, and it's not clear where the bottom is. So, as investors, we have to ask ourselves, do we ride out the storm, or do we take action before the next wave hits?
April 4th, 2025, and the markets are hanging by a thread. After China's retaliatory tariffs, global markets are shaken to their core. The Dow is down over 10% from its December peak. The S&P has entered correction territory. But there's something bigger at play here. Something that might make 2025's market meltdown feel like 2008 all over again.
We've already seen $5 trillion wiped out from global markets in just 2 days. And yet, this feels different. The market isn't just reacting to tariffs or trade wars, it's reacting to a deep systemic risk that's been building for years. The question now is, are we facing a Lehman Brothers moment, but on a global scale?
Let's break it down. The yield curve inversion is one of the clearest signs that something is off. We've seen the 2-year Treasury yield surpass the 10-year yield, which signals that investors are rushing into short-term bonds, fearing long-term economic instability. The 2-year yield is at 4.38%, while the 10-year sits at 4.2%. That inversion is a big red flag.
And it's not just the yield curve. Junk bonds are seeing spreads widen to 401 basis points. That's the highest we've seen in 17 months. Investors are fleeing riskier assets and liquidity is drying up. But it's not just the bond market that's sending signals of impending danger. It's the global economy collapsing under the weight of this tariff war.
If we look at the numbers, the story becomes clearer. The VIX, which measures market volatility, is spiking, closing at 29 on April 3rd. That's its highest level since last August. The last time we saw the VIX at these levels, the market was in the midst of a full-blown panic. So, what's next? Are we heading toward a systemic collapse, or is this just a temporary shock?
There's a real possibility that this crisis could be more than just a recession. We're witnessing a deep global correction. The systems that have kept markets stable for decades are starting to crack. There's one thing we know for sure. This isn't business as usual. The market is telling us something is wrong. The question is, how bad will it get?
This is the kind of moment that defines a generation of investors. In the wake of Lehman Brothers, we saw a complete overhaul of global financial systems. If this crisis continues, we could see a similar reset. The question is, who will be ready when the dust settles?
As investors, we have to stay ahead of the curve. This isn't a time to panic, it's a time to act. As the global economy shifts, there are opportunities for those who know where to look. But the key is in the timing. If you wait too long, it might be too late.
By April 4th, 2025, the damage is clear. $5 trillion erased from global markets. This isn't a market correction. This is a reset. The economy is shifting, and with it, the sectors that once dominated the landscape are starting to falter. But as the chaos unfolds, there are always winners. And right now, those winners are in defensive sectors.
Let's break it down. The market's been thrown into a tailspin, but in the world of investing, there's always a way to adapt. While the tech giants are getting hit hard, defensive sectors like healthcare, utilities, and defense are standing strong. They're the safe havens in a storm, and investors are flocking to them.
Take Lockheed Martin, for example. While the broader market tanks, Lockheed Martin sees a solid 3% gain. Why? Defense spending is one of the few things that remains stable during a geopolitical crisis. Governments don't stop investing in defense. In fact, it's one of the sectors that gets stronger in times of uncertainty.
Lockheed's rise is no fluke. The company's backlog sits at $176 billion as of April 1st, which means they have a solid foundation of contracts to keep their revenues flowing. In times of crisis, companies like Lockheed are able to weather the storm better than most, and their stock prices reflect that.
Meanwhile, sectors that rely on global trade and supply chains are suffering. Automakers like BMW and Daimler are down over 5%. The aerospace industry, struggling as Boeing faces continued delays and cost overruns. The companies that thrive in good times are now on the defensive.
And it's not just autos. The consumer discretionary sector is taking a hit too. Brands like Nike, which saw a 14% drop, are struggling as the price of raw materials rises and the cost of doing business in China becomes more expensive. And don't forget about the agriculture sector. Soybeans are dropping sharply, losing over 2.5% in a day. Farmers who once relied on China's $29 billion market are now facing a significant loss.
But let's not forget about the financials. Banks are tightening up. The 60% recession odds from JP Morgan are becoming more likely by the day, and liquidity is drying up. Junk bond spreads are at a 17-month high. Investors are fleeing to safer assets, and those who were overexposed to high-yield bonds are feeling the pain.
But for every loser in this crisis, there's a winner. Defensive stocks like utilities, telecoms, and consumer staples are holding up better than most. These are the companies that provide basic needs, things people can't live without, and they become more attractive in times of uncertainty. When the market shakes, investors flock to stocks that can ride out the storm.
So, the big question for investors now is, how do you position yourself in a world gone defensive? The answer is simple. Look at sectors with stability. Right now, healthcare and defense are the sweet spots. These sectors are less affected by trade wars and market shocks, making them the best places to park capital while the storm rages. It's April 3rd, 2025, and the markets are in freefall. The tariffs, the geopolitical tension, the uncertainty, it's all coming together in a perfect storm. But there's something else amplifying the chaos, something that traders can't control. The machines. In a market like this, algorithmic trading isn't just helping. It's making the panic worse.
Algorithms have been quietly running the market for years, but in a moment like this, they can become the ultimate instigators of volatility. The problem with automated trading is simple. It doesn't have a sense of panic, and it doesn't have context. It just reacts to the numbers, and when it sees a drop, it sells.
The machines aren't panicking. They're following orders. And those orders have a predictable result. On April 3rd, high-frequency trading algorithms kicked in almost immediately as markets began to slide. In just 17 milliseconds, the sell-off intensified. That's how fast it happened. These machines were designed to move quickly, but now their speed was adding to the panic.
Goldman Sachs has confirmed that 60% of the market drop was driven by algorithmic deleveraging, these automated systems unwinding positions and triggering a wave of selling. Traders expected volatility, but this was something different. The algorithms didn't hesitate to pull out of everything they could, and the result was a steep, rapid decline.
And let's not forget how these systems work. The faster they trade, the more they can push the market lower in a shorter time span. With trillions of dollars at play, these algorithms were programmed to react faster than any human could, creating an overwhelming feedback loop. The algorithms made the sell-off happen quicker, harder, and more violently.
By April through its close, the S&P had dropped 6%, and the Dow was down 2,231 points. The machines had made their mark, but it wasn't just the stock market feeling the effects. Bond markets were in turmoil as well. Junk bond spreads widened to 401 basis points, the highest in 17 months. The panic wasn't just in equities, it was systemic.
The issue with algorithmic trading is that it doesn't account for broader market sentiment. It reacts to the data, not the news. And in a moment like this, when news is driving the market, that's a serious problem. The machines are programmed to sell, but they can't process the bigger picture. So the question is, how much damage have they really done?
The question isn't just how much damage has been done, it's about how much damage will be done. Because the algorithms don't stop. They keep moving, reacting, pulling out of markets faster than any human trader could ever do. In this kind of environment, the market can't stabilize, not when 60% of the drop is driven by machines.
The fear is that this is just the beginning. Once the machines have set the pace, it's almost impossible to stop them. In fact, we could see more instability as long as automated trading systems are calling the shots. This isn't a market driven by human instinct or analysis. It's driven by cold, calculating algorithms that don't know fear. All right, we've laid out the carnage, and now it's time to ask the real question. How do you turn this disaster into an opportunity? In times of chaos, there's always a way to profit if you know where to look. The question for investors is simple. Which sectors and assets can thrive in a time of trade wars, tariffs, and market instability?
It's not just about weathering the storm. It's about positioning yourself ahead of it. Right now, while the market is panicking, defensive sectors are proving their resilience. But it's not just the traditional safe havens like utilities and consumer staples. There are opportunities in ETFs and stocks that are benefiting from the volatility itself.
One of the biggest opportunities right now is in the aerospace and defense sector. Lockheed Martin, LMT, is up 3%. And it's not just because of strong earnings. This is a sector that thrives in times of uncertainty. Governments ramp up defense spending in geopolitical crises, and as tensions rise, defense companies stand to benefit. And don't forget about the potential surge in defense contracts. Lockheed's $176 billion backlog is a clear indicator of future growth.
In addition to defense, there's another sector that's getting an unexpected boost, the healthcare sector. Healthcare stocks are traditionally seen as a safe haven, and with the market in turmoil, investors are flocking to these defensive assets. Companies in pharmaceuticals, biotech, and even health insurance are holding steady, and some are even seeing gains as investors seek stability.
But it's not just about individual sectors. The broader market is offering opportunities as well, especially in ETFs that are positioned to benefit from the market volatility. Take the VIXI, for example, the VIX ETF. As the volatility index spiked to 29, VIXI surged by 25%, offering a perfect hedge for investors who had positioned themselves correctly.
The VIX is a perfect example of how volatility itself can become a profitable asset. Investors who understand how to trade volatility, especially in uncertain times like these, can make significant gains. When the market's uncertain, volatility is your ally, if you know how to play it.
Now, let's talk about international exposure. The FXI ETF, which tracks China's largest companies, took a massive hit, down nearly 5% over the past few days. This is where you can go the opposite direction, buy into the weakness. When these markets stabilize and China finds its footing again, this ETF will be one of the first to recover. In fact, that's exactly what we saw last year after similar tariff fears. Prices dropped, then bounced back with a vengeance.
But this strategy requires patience. Volatility doesn't just open the door to quick profits, it can also trap you if you're not prepared for the long haul. So while we're watching the fallout from these tariffs, remember, there's opportunity in the chaos. The key is knowing when to move and when to wait.
So, to recap, here are 3 trades to consider in this volatile environment. First, Lockheed Martin, defense stocks are proving resilient, and Lockheed's solid backlog makes it a winner. Second, VIXI, the volatility ETF, is a perfect hedge in uncertain times. And third, the FXI ETF, China's suffering now, but once the dust settles, this could be a big recovery play.
In times like this, markets aren't just reacting, they're recalibrating. There's money to be made in the chaos. But you have to act quickly, and you have to be strategic. Don't just wait for things to stabilize. Make your moves while others are paralyzed by fear.
That's all for today's episode. We've taken you through the storm. Now, it's time for you to take action. If you haven't already, subscribe to our podcast, follow us on X, and share this episode with a friend who needs to see how the next financial wave will break. And remember, stay ahead of the curve, because when the markets shift, the winners will be the ones who saw it coming.
Before we go, remember, the information shared in this podcast is for educational and informational purposes only. It's not financial advice. Always do your own research and consult a licensed financial advisor before making investment decisions.
Credit markets are volatile. Downgrades, rate shifts, and macro shocks carry real risk. Always assess your exposure, your mandates, and your margins before acting on market moves.
Music in this episode, including Not Without the Rest by Twin Musicom, is licensed under the Creative Commons Attribution 4.0 license. Finance Frontier AI Copyright 2025. Unauthorized reproduction or distribution is strictly prohibited.